Imagine a bank. Every morning, people walk in and make deposits. The bank takes that money, lends it out, invests it. At the end of the month, it pays those depositors interest. Deposits are useful, but they have a cost. Now imagine a different kind of institution. People voluntarily send it hundreds of billions of dollars. It invests that money, and instead of paying interest, they pay it. That institution exists. It's called Berkshire Hathaway. But to understand why, you have to start with what this company actually is. Most people think Berkshire Hathaway is a stock portfolio. Warren Buffett buys Apple. Warren Buffett buys Coca-Cola. That's the story everyone tells. That's not the business. Berkshire owns 189 companies. If you separated many of them, they'd be Fortune 500 companies on their own. Yet almost nobody buys Berkshire because of the railroad, or the utility, or the manufacturers. They buy it because of Buffett. That's a mistake. In 2025, those businesses generated $371 billion in revenue. BNSF alone earned $5.5 billion in net profit, moving freight through 28 states, regardless of what the market was doing. These businesses share one characteristic above everything else. They generate cash, constantly. And when I first looked at that number, the question that stayed with me was, where does all that cash actually go? The biggest source of investable capital inside Berkshire isn't those operating businesses. It's insurance. Here's how the model works. You pay your car insurance premium in January, the full year up front. Geico might not pay a single claim for you that entire year, or it might pay one in November. Between when the money arrives and when it leaves, there's a gap. At most insurance companies, that money sits in investment-grade bonds. Safe, predictable, low return. At Berkshire, it goes to Warren Buffett. In 2025, that float, the total amount of insurance premiums held before claims are paid, reached $176 billion. And the cost of holding it was negative. Most insurers roughly break even on the actual business of insuring. Their profit comes from investing the float. Berkshire's insurance operations don't break even. They profit. Geico's combined ratio in 2025 was 84.7%. Think of that number as a receipt. For every $100 Geico collected, it spent $84.70 on claims and expenses. The remaining $15.30 stayed as underwriting profit before investing a single dollar of the float. Go back to the bank. A regular bank pays its depositors to keep money there. At Berkshire, the depositors pay Berkshire. Over the past 20 years, the insurance operations generated $32 billion in after-tax underwriting profit, while the float grew from $46 billion to $176 billion. The float arrives with a profit attached. That's the engine. At the end of 2025, Berkshire was holding $369 billion in cash and treasury bills, and deployed almost none of it. Buffett bought back 0 shares. The program is active. He simply chose not to use it because the price wasn't right. The businesses generated $46 billion in operating cash. After $20.9 billion in capital expenditures, free cash flow came in at $25 billion. New capital every year looking for a home. Most CEOs feel enormous pressure to do something with that. Berkshire doesn't have quarterly earnings calls. The company is structured for long-term owners. And that creates something rare. the institutional permission to do nothing when nothing is the right answer. The portfolio reflects the same logic. $298 billion in public equities, and the top 5 positions represent 65% of the entire book. Not diversified across hundreds of bets, concentrated. Coca-Cola entered the portfolio in 1988. Cost basis, $1.3 billion. Today, it's worth $27.5 billion. That return came from holding through the dot-com bubble, the financial crisis, the pandemic, and every credible argument for selling that appeared along the way. Then there's Japan. Starting in 2019, Berkshire quietly accumulated stakes in 5 Japanese trading conglomerates. Cost, $13.8 billion. Today, worth $23.5 billion. Financed with yen-denominated debt at near zero fixed rates. The annual dividends cover the interest 6 times over. Most investors saw Japan as complicated. Buffett saw 5 businesses trading below what he calculated they were worth. The decision looks elegant in retrospect. It only became obvious after he made it. The float itself isn't the hard part. Every insurer has one. What makes Berkshire different isn't the existence of the float. It's the cost. To hold float at negative cost, you need to be profitable at underwriting, consistently, for decades. Not just in good years, in catastrophe years, in years when inflation drives claims higher than any model predicted. In 2022 and 2023, Geico failed that test. Claims came in faster than pricing could absorb. The combined ratio crossed 100. The advantage temporarily disappeared. Todd Combs spent 2 years fixing it. He cut unprofitable policies, tightened underwriting standards, rebuilt the pricing model from the ground up. Fewer customers, lower revenue, a worse result by every metric Wall Street watches. Most companies can't make that call. Not because they lack the insight, but because the incentive structure makes it nearly impossible. Fewer policies means lower revenue, means a worse quarter, means pressure from analysts, means pressure from the board. Nobody called Omaha demanding an explanation. And by the time the market noticed, Geico's combined ratio was back to 81.5%. That's the moat. The structure that allows the float to stay cheap, even when fixing it requires making everything look worse first. This is where the data stops. Since 1965, Berkshire's per share value has compounded at 19.9% annually. The S&P 500 at 10.4%. The overall gain since 1964, 5,502,000%, against the S&P's 39,000. Those numbers are the output of 60 years of one person's judgment. Greg Abel is the designated successor. He knows the businesses, he understands the philosophy. But try to write down the process that produced that record, the checklist, the decision tree. You'll find there isn't one. The model exists inside one person's head, built over 70 years of reading businesses, making mistakes, and adjusting in ways that were never documented. The float will still be there. The businesses will still generate cash. But the most important decisions Buffett ever made weren't the ones where he acted. They were the ones where he didn't. The acquisitions he walked away from. The $369 billion sitting in treasury bills because nothing met the threshold. Greg Abel inherits the machine. The question is whether he inherited the threshold. One dividend, ever. January 1967, 10 cents per share. Buffett still calls it a mistake. 60 years of reinvesting every dollar. $101 billion paid to the US Treasury in taxes. 5 million% in cumulative returns. Most people think Berkshire is a portfolio. It isn't. It's a machine that converts discipline into capital, capital into ownership, ownership into even more capital. Warren Buffett designed the machine, spent 60 years calibrating it. The question isn't whether it still works. In 2025, it generated $46 billion in operating cash, so it works. The question is whether the person now operating it knows when not to use it.